We're talking mining across the board. You were at the Goldfields Investor Day. How serious is the situation in Ghana, and what does it mean for Goldfields?
Yeah, it's fairly serious. You know, Nick Holland said, if they're going to get to a compromise or something, there's a couple of the projects, especially the super pit, the Damang super pit, that may be off the cards. So it is fairly serious. It sounds like they've made progress, and that you may see a win-win outcome on that.
Do you think government is going to engage?
Well, I think on the gold space, they're by far the biggest player there, and they're prepared to invest a lot of money in the country, and it's always that kind of scenario of saying, will they really call the bluff or not? Nick Holland seemed to be very vocal on this and very kind of open and
he's going to strong arm them into doing what he wants.
He didn't beat around the bush, and he basically said, it's excessive, it's too much. If you look at Ghana's cost over the last sort of 5 years, has gone up by 100%, almost like 20% per year. So there's already a lot of cost pressures, and I think this tax is maybe just too much. He's got a problem mainly with the windfall tax in particular.
Kobus, is this a tax on all mining companies, or do you think there's a targeting of gold specifically?
Yeah, he mentioned that the playing field is very uneven. So there's not, it's not same principles, even for, say, I think for other gold miners. The one guy may have a exemption or some sort of agreement, and the other guy. So it seems like there's a lot of differences at the moment in that space, which obviously need to be cleared out to secure future investment, I would argue.
And we were chatting earlier about the challenges of investing in these single commodity stocks. Do you think that this is a key risk going forward? Would you stay away? In other words, would you stay away from pure play gold miners?
No, not in this environment. I'm fairly positive about the space. Like anything in life, risk reward. And I think these miners obviously need to incorporate this when they scope for these projects, when they calculate, when they sort of use hurdle rates, etc., etc. They got to incorporate this type of risk. It's par for the course. But as anything, I think these governments are seeing the gold price. They are hearing of all this money these companies are making, and obviously they want a piece of that.
When you say that you like this space, what in particular do you like, or which stock in particular do you like as an entry point into gold?
Yeah, Goldfields, I would argue, is probably the preferred pick at the moment. Anglo Gold is sort of the blue chip white horse. It's the best of the breed, but it's very over-owned, I think. There's not a lot of additional buying, I think, that can necessarily come in. So, and in a couple of metrics, as Goldfield is looking more attractive than Anglo Gold at this stage of the game, especially with this higher gold price, which has got slightly higher gearing, operational gearing as well. So it would benefit a little bit more.
Kobus, why do you think the Goldfield share price didn't respond more emphatically to this news? It was down only 1%.
Just over 1%.
Look, effectively they've done away with a tax of about 5%, and they've increased this mining tax from 25 to 35%, and then the windfall tax, which could be as
additional 10%.
As 10%. But again, that is sort of dependent on the profitability, my understanding is, of the company. So it isn't that big a deal. I don't want to say it's nothing, but maybe you take off 3 to 4, maybe 5% of the, the NPV evaluation. These stocks do show attractive upside to current prices, and it's something, but it's not a. It's not a major.
We've just got an email in, and while you're here on gold, a gentleman went to dinner last night, and he told people that New Gold had reached a record price of 105 Rand. That was on the 14th of July 2011. I hope you're listening closely here, Kevin.
I am intending.
He says, imagine their reactions when I informed them that New Gold had in fact increased to 136 Rand since then, i.e. 30% increase since its record in August. That's in the last 4 months. I think it's time someone on CNBC actually took note and mentioned the performance of New Gold relative to other asset classes out there. Well, you're the expert, so tell us about.
Look, if it's a South African New Gold he's talking about, that is effectively the rand, the gold price in rand. That is our ETF, and we've.
But it shot the lights out.
100%. It went up as high as over 140 at a stage from. I remember last year, sort of this time around, it was 87 Rand. So it's a
nothing to sneeze at.
Close to 50% increase. Look, whether you buy the physical gold or the shares, I would lean at this stage more towards the shares. I think we've started to see some maybe since August, some outperformance of the gold index relative to this specific GLD. And I think it's sort of got to a time, you know, if you haven't been in it and you enjoyed that 50% ride, a lot of these gold companies haven't joined into that strong rally, and you know, maybe you sort of missed that boat, and the next
Kevin
opportunity
missed the boat.
is
You missed this boat, didn't you?
Emphatically, yes, I did. Yes, I've admitted. How many times you want me to
I have
admit
to
it on
double
the
check
show?
because I've been told now to double check that you understand what you've missed out on.
And I'm going to wait for the email when it reverses. Right, we are going to get that email.
We've got to talk about
Ring the bell.
platinum as well. How do we stand on the platinum stocks? Again, we're into that single commodity play. Do you take the risk?
Look, at this point, no. You know, I think of what's been going on in Europe, which is the largest source of autocat demand, is basically the light diesel vehicles coming out of Europe. I would be very cautious of investing into the space. I guess there's a lot of fund managers and people that would argue it offers a lot of value. You know, if you look at a company on a price to book basis, or you look at it on its margins or return on capital, and you compare it of what it's done over the last 10 years, then it is well below mean. It's below the standard deviation sort of kind of metrics, etc., etc. I just think you may get it cheaper next year, and I think it may look like value a lot longer than a lot of people may think.
Kobus, the local production has been a problem in terms of local platinum production has gone through a difficult phase. How long do you think it's going to take before production locally is kind of, let's say, back to normal? Are we looking only at next year, or do you think they're getting things right?
I guess one first need to say what is normal and what's maybe the new normal. I think what one have seen, and specifically in the platinum space, in my view, one have seen sort of an over-investment in 2007, 2008, 2006, 2007 maybe, over that period. And I think the market have been flooded with metal. I mean, you know, we've heard this last week, Johnson Matthey coming out sort of saying that the market is in surplus most likely this year, around about 200,000 ounces. That will most likely be the position next year as well. If you look at some of the other market commentators, they're sort of talking towards a bigger surplus even. So there is definitely a big surplus, and I would lean to the side that maybe that surplus is a lot bigger than a lot of people want to give sort of credit for that. And unfortunately, the industry need to restructure. And what's been going on in Europe, I can't see it coming from a demand perspective. So you got to see this actually coming from the supply perspective, from the actual producers, i.e. the platinum miners, the mining companies, the likes of Anglo Platinum and Impala Platinum. And unfortunately, when you operate in an environment where you got to pull back your volume, which we've already seen some of that, capex getting delayed, etc., and you automatically your cost goes through the roof. And if you then operate in a low price environment, your bottom line is going to feel it.